Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. On this episode of the Wealthy Behavior Podcast, we're excited to be rejoined by Jeff Kleintop, Charles Schwab's Global Chief Investment Strategist. Jeff is a longtime favorite of Heritage Financial and our clients. We've done events with him, and he's been on the podcast before. It's always a treat. We're global stock market investors at Heritage Financial, and the ability to plug into somebody who's thinking about those markets the same way we do and get his insights is always special. So thank you for joining us, Jeff.
My pleasure. Thanks for having me back on. Always great to be with you.
Absolutely. So, to maybe set this up, I wanted to ask, for people who don't pay as much attention to it as you and I do, how are the markets doing globally? If you look at the US, developed international, emerging markets, what's the setup? What's going on in those stock markets right now?
Well, they're doing really great this year. We've got pretty strong international returns, and it's interesting. You've got emerging markets that are up. I mean, I can. We're doing this on the 19th here. Just looking over at my screen, so you've got emerging markets up about 7% this year. You've got international markets up 8% or so, and you've got U.S. markets up about 4%. So they're outperforming. They're doing well. And what's really interesting about that is that was not the consensus late last year. With Trump's win and this consensus around America First policies, the gut reaction for so many investors was, hey, U.S. stocks must be the winners here, and international stocks are really going to underperform. Kind of echoed what we saw back in 2016 when Trump won for the first time. From the election day in 2016 to the end of the year, international and emerging market stocks really underperformed, and U.S. stocks led the way. And that was true from the election in 2024 to the end of 2024 as well. But what happened in 2017, the first full year of Trump's term? International stocks outperformed U.S. stocks that year. And emerging market stocks outperformed even more. In fact, they were up 40% in 2017, led by China, which was up 56% in 2017. And we're seeing echoes of that again this year. Chinese stocks, incredible performance so far this year. Emerging market stocks up a lot. U.S. stocks, or international stocks outperforming U.S. stocks. So it's a little bit of an echo what we saw back in 2017. And real quickly, I'll just say, for a lot of the same reasons, global growth is actually improving this year, despite all the headwinds and concerns about tariffs.
Great. So that was the next question I was going to ask you. But besides kind of the global stock market setup, how about the global economy? And you're looking at those three regions. What's the setup now?
Better, but still not good. So We're coming off of what I've been calling a cardboard box recession, because literally demand for cardboard boxes was in a recession over the last couple of years. We saw economies like Germany in and out of recession every single quarter for every other quarter for the last 2 years. So we've seen a lot of manufacturing based countries like Japan, like Germany, really suffer, where making things and selling them around the world just wasn't the place to be. Services were booming. You can just ask Taylor Swift how strong services were. But what we saw was that anybody who made stuff really suffered. And that was true in the US as well. But most of what we do in the US is in services. 9 out of 10 jobs are in services. So we didn't feel the brunt of it, but it really was felt in economies in Europe and Japan. But that's now turned around. Cardboard box demand is now rising. Inventories have been pulled down, and we're seeing a recovery emerge in manufacturing. And that's really helping to lift some of these economies. There's still growing below their longer term potential rates, but much better than the last couple of years. And what's coming along with that are much stronger earnings growth. And in fact, the best earnings beats we've seen in 10 years coming out of this quarter's results. So finally, a turnaround. And markets, as you know, tend to respond more to better versus worse than good or bad. And that's what we're seeing, better growth outside the US here in 2025.
So that was some of the explanation for why the U.S. market had outperformed international, stronger earnings growth. I would also say multiple expansion was a big part of it. I think there was some currency moves that hurt international stocks. Is that setup, I guess, changing? Has it evolved, or we're starting to see global earnings catch up with the U.S.?
Yeah, that's all three of those I think are changing to some
Okay.
degree. The earnings picture the momentum is improving there. We're seeing better earnings growth outside the US for the first time in a while, coming off of a low base. We're looking at, year-over-year declines last year, right? So we're easy comparisons as opposed to in the US where you had those big Mag 7 earnings really making for higher hurdles this year. So yes, better earnings growth. Valuations are a huge standout story. They have been for a while, but they're dramatic now. Usually international stocks trade at about a 17% discount to the US stock market on a forward PE basis. And that's largely because of sectoral differences. But we're looking at a 37% discount now, widest we've ever seen. And for, again, good reasons, many of those you just pointed out over the last year or two. But that's starting to converge as growth is picking up in the US, earnings are turning around, and we're seeing more optimism come into investors in Asia and Europe. I'd point out Europe, this is an economy that's in a 2-year recession and a war on its eastern border, and looks like those things may be changing. Optimism may be coming back. I'd like to point out to just an example, if I can, of two stocks, Coca-Cola versus Nestle. Coke, a US-based company, of course, Nestle based in Europe. They both sell the same thing, snacks and beverages, to pretty much the same geographic footprint around the world. Their footprint of sales by region are pretty much the same, operations as well. And the revenue growth looking out over the next year, pretty similar, 2 to 3% revenue growth for both companies. But Coke currently trades at about a 22 forward PE, Nestle at 16. That gap is at a record wide gap. And it's not because of anything fundamentally different here in terms of their outlook or growth. It's just that US investors, who make up 80% of the investors in Coke, are much more optimistic about the outlook generally than European investors for reasons I talked about. I think that convergence will help see that valuation gap narrow. So quickly to recap, earnings improving, valuation gap, I think, narrowing. And on the dollar, well, that's anyone's guess. It's really hard to predict the dollar. But I would say that a lot of dollar strength late last year was priced in around maybe the Fed holding pat this year, while other central banks cut rates. We know short-term rates affect currencies, but also just the outlook for tariffs and concerns there. Generally, a company that puts on tariffs sees its currency rise. Now that we've seen some delays in some of those tariffs and not sure how they're going to unfold, maybe we've seen a little bit of weakness in the dollar year to date. Dollars down about 1%. So maybe a little bit more weakness in the dollar would also be a wind in the sails of investors overseas.
So, what do you think is driving some of that optimism in the developed international markets, the markets that you focused on in your last answer, particularly given the setup with your answer to the first question about the narrative that America first, could be better for U.S. stocks and detrimental to international stocks? So, is it because the tariffs may be a false start, or maybe more negotiating tactics, or is there something else going on?
Well, there's certainly that to it. There's also maybe some confusion around tariffs. I'll give a quick example in Mexico. Mexico is certainly very dependent on exports to the U.S. economically. Their GDP is very heavily weighted to that. But the companies, not so much. So if we're talking about earnings, it's a very different picture. The biggest exporters from Mexico to the U.S., those who will be hit by 25% tariffs, are actually GM and Ford. Those are the biggest exporters from Mexico to the US, right? They're US headquartered companies listed in the S&P 500. The five biggest Mexican companies in Mexico's stock market, making up 50% of GDP, are a telecom company, a bank, Mexico's Walmart, and a Coca-Cola distributor. Those four don't have any exports to the US. So the large portion of Mexico's stock market would not be affected at all by tariffs, even though its economy would be affected. So I think there's a different impact in terms of the stock market impact versus the economic and export impact. So that's just one example, but we can see a number of those. And I think that's part of the backdrop, is that there's more nuances to this tariff thing than it may seem on the surface. The other thing is that we weren't the only country last year to see its incumbent government change. Every single country in the world that held an election, every developed country that held an election, there were a lot of them, biggest election year ever, 2024, we saw governments change across the board. And the result of that is a bit more of a my country first policy taking place around the world. And so what we're seeing is more fiscal spending. Germany's going to have an election on Sunday, and the outcome of that is probably more fiscal spending in Germany, extending to the rest of the Eurozone. More defense spending in Europe. We know that can offer some stimulus as well. So a lot of drivers that are coming out of the elections in 2024 that may actually be economically stimulative to Europe and in Asia that maybe weren't top of mind just post-election.
Yeah, so I think investors are just being more discerning, right? They're engaging
Yeah.
in next level thinking, not tariffs could mean this, but digging into some of the examples that you laid out, tariffs could actually mean this. And there are other things going on that could make the setup for international markets more attractive than what you would initially feel.
Yeah, just to add to that for a second, there's kind of a new Mag 7 going on right now. There are 7 European stocks in the MSCI EMU, that's European Monetary Union, Aerospace and Defense Index. They are taking off. They're up 138% since the bear market low. They are killing it this year. They're up 20% this year versus the US Mag 7, which I think is up 1%. So kind of looking at where is the incremental spending going to come and where are we going to see maybe big government outlays? And that could be in defense stocks in Europe. So you're right, kind of a shift in the mindset, people thinking now second, third order level thinking. And that's playing into incredible performance in some of those defense names in Europe.
So you sound fairly optimistic about the global markets, or am I reading into that?
I am fairly optimistic, but to be fair, I've been talking about outperformance of international for a couple of years now, and last year was a real disappointment for me in the fourth quarter. Really seeing international underperform again around some of those America First thoughts was really a blow. But actually, if you go back to October of 2022, when the bear market low ended for the S&P 500 international markets, we're actually seeing markets like Europe actually outpace the S&P 500. I think few people know this, that Europe stock market has outpaced the S&P 500 since this bull market began. But I've been a champion of this, and I think we are in a new cycle and a different environment. Inflation is much lower in Asia and in Europe. That allows more central bank rate cuts. That should be great news for their economies this year. So that's another plus. Again, this economic improvement that they're seeing, I don't think that's going to get derailed by tariffs, although admittedly it is a risk. We're also seeing maybe this valuation improvement, a return of some optimism in some of these markets that we haven't seen in a while on the back of that better economic performance and maybe a ceasefire deal between Russia and Ukraine. I don't know what the status of that is going to be, but certainly there's some optimism around that finally ending. So a lot of those factors really playing into a better outlook for international markets this year than we've seen in a while, and certainly something we're seeing already take root in the stock market.
Could that be detrimental to U.S. stocks, or is this more the giving international markets an opportunity to catch up and join the party, so to speak?
When I think about international investing, global investing, I often just come down to sectors because so many countries just look like a sector ETF. We've talked about this before, but the US really looks like a tech ETF. And so if we broaden away from tech, and we have a little bit this year, to financials, industrials, energy, a few other sectors, that probably means international leadership, but it doesn't mean all US stocks underperform. It just means maybe the tech sector lags a little bit. We've got a lot of financials in the US and a lot of industrials, a lot of other sectors that can finally begin to carry some of the burden of performance. So maybe there's a second wind in US markets as well, but it's going to be away from, I think, the areas that wow, maybe a whole generation of investors haven't even thought about. It's just been US tech for so long, but a broadening there, I think, could be good news for the US also.
What do you see going on in China?
Oh boy. So yeah, China's a tough one, right? In part because so much is driven by policy changes and they're just opaque. They just get announced when they get announced. So on March 5th, we have the National People's Congress meeting where sizable and concrete fiscal stimulus could be unveiled. Now, they've given us false starts before, but it seems like now that they have a better sense of what the tariff environment's going to look like, the political environment's going to look like, they can maybe begin to deliver some stimulus to consumer and business confidence. And that is something that investors have been looking for, and it's one of the reasons why Chinese stocks have been bid up this year. But there are deep-rooted problems there, particularly in their property market. Property is generally where a lot of Chinese investors put all their wealth. And so when the government decided that there was too much money going into housing and they wanted it to go in other areas, they simply cut off a lot of the builders there from being able to borrow and deliver homes to people who had put down payments on them. And now those people who put down payments are worried about either not getting their money back or not getting a home delivered. And that's been a real crisis of confidence in China. There's the potential to turn that around. There's still a lot of savings in China that could be spent. China's direct exports to the US only account for 3% of GDP. So tariffs aren't the big deal. It's domestic consumer spending, which is well over 50% of their GDP, that's just chronically weak because of this lack of confidence. So March 5th, high stakes if they deliver some good stimulus numbers out of that. And I think increasingly that's the expectation. China could begin to turn around. It's one of the reasons why Chinese stocks were up 56% in 2017, because not only did global growth improve, but China unveiled a big stimulus program, and we saw stocks rebound from very low valuations. That's how we're positioned today. But boy, a lot of volatility there. I'm optimistic about emerging markets this year, but I still think they ought to maybe only deserve a relatively small portion in a portfolio, given just the potential for a lot of volatility.
Okay, so is it's potential then that if some of those stimuluses don't that those measures don't pan out, that the market may have gotten ahead of itself, at least with
Yeah,
China optimism?
I think so. I mean, you're looking at a 20% gain this year on the back of, some gains probably from, around mid-October, mid-December of last year. So yeah, we're really building into a big run up here, but this is often what we see in China. Huge run ups in short amounts of time, and then they kind of languish a little bit, and then they get another huge run up. So it's one of the reasons why it's very difficult to time investing in China, and why a long-term allocation to that market, or EM in general, is pretty important. And I'd note that India is kind of the opposite of China, and it offers some interesting diversification. So India's been disappointing here lately in its markets as China's rebounded, but that's the opposite story the last couple of years, where India did really well and China didn't. Everything seems to be going well in India economically, just even politically, but the stocks are valued very highly, right? About 22 times earnings, whereas China, very low valuations, but things have been really, really falling apart. So they offer some diversification within the emerging market space that's really kind of paid off, as opposed to just betting on one market or the other. And I think that might continue to be the case this year.
Okay, we've spent a lot of time last year on the podcast talking about inflation and rates. Where are we in the global inflation fight and with central bank policy right now?
The US inflation still looks pretty tame. We're
Hmm.
talking about 2% or sub 2% in many economies around the world. And that allows them the flexibility to keep cutting rates this year. The European Central Bank probably cuts another 4 times this year. Bank of Canada, the Bank of England, Reserve Bank of Australia just cut rates for the first time last week, and they're probably headed to do more of that. So, yeah, we're in an environment where inflation seems to be fairly well contained. In the US, there are some unique issues that are bolstering inflation, but generally, we're not seeing those pressures outside the US. There's reasons why they could surge given maybe a global trade war, but that's not our base case. I think inflation stays low. We continue to see those rate cuts.
Which should be a tailwind for international equities compared to the US if we can't be as accommodative here, right?
Yeah, that's true. There's no guarantees, but whenever we've seen rates going down overseas in general, they've led to a rise in the PE ratio of those markets. So hopefully that plays out again this time.
Anything you're concerned about?
Oh, wow. So, I mean,
Well, let me
obviously,
rephrase so we're not here for the rest of the week. What are your top two or three concerns?
yeah, I mean, obviously tariffs are the number one issue right now, and it's just every day, what's that going to look like, and how is it going to shape up? What are the investments going to look like from a governmental standpoint, and how are they going to unfold in Europe, for example? Again, we've got an election coming up. So, are we going to see Europe come together on defense spending, or are they not? What are we going to do about, the electrical grid, both here and abroad? A lot of those questions are really important going forward, particularly with aluminum tariffs. Aluminum is just bauxite and a whole lot of electricity. 97% of the cost of aluminum is electricity, and we just don't have the capacity to do it here. And they're struggling to build that capacity in Europe as well. So there's a number of those challenges. Semiconductors, where are we in that cycle? I feel like the data I'm looking at shows we are rolling over in a classic semiconductor cycle. I don't know if that applies to AI, but it certainly does apply to processors and memory chips and those types of things. I don't think the market's yet positioned for that.
What
So
does
that could
that
be a
mean,
little
Jeff? Maybe
disappointing.
sorry, can you elaborate a little bit on that? Explain that in more detail.
Absolutely. Thanks for the opportunity to do that. I just sometimes bring these things up. So semiconductors go through a classic boom and bust cycle where
Okay.
there's a shortage, there's a lot of over ordering, and then those orders begin to come through. Maybe demand pulls back a little bit, and you see a lot of orders get cut. Frequently, we see the revenues and earnings of semiconductor companies go through these big up ramps and then big declines as well. And it tends to drive the stocks, although not as dramatically as the swings in revenue or earnings. And that seems to be where we're at now. A little bit of disappointment in terms of the uptake on demand for semis, and some of the products, a little bit of a slowdown in EV demand, that type of thing. And so we're seeing a roll down, not only just softer demand, but actually cutting order. And that tends to be a problem for the semiconductors, the stocks, and they tend to go into this sort of like 12-month long downturn. And I'm seeing some signs of that that's worrying me a little bit. Again, a lot of the leadership of the last couple of years have been in the whole tech and tech hardware, and particularly semiconductor space. So if that's starting to roll over, that can foster more of this rotation in the markets, which can be unnerving. There's just the conflicts that we're looking at right now. How do they shape up? What is the resolution for Ukraine going to look like? The number of geopolitical issues right now. How is Iran positioning itself for the outcome of or the upcoming negotiations with the Trump administration? Very interesting. Iran has 40% inflation, a recessionary economy. Most of the population is under 30. This is the kind of environment that led to revolution in 1978, 1979, that led all that Iranian crude to come off the market and a huge surge in commodity prices. And we know what happened in the 70s with inflation. And there's all those kind of parallels going on now. So commodity prices beginning to pick up a little bit here. So a lot of things I'm watching we know if inflation were to come back in a significant way, that would be a big negative for the market. So it's another thing I'm keeping my eye on.
You mentioned Ukraine. Is there a ideal scenario for how that conflict gets resolved for markets?
I think for markets, they'd like to see something that keeps Russia from expanding into Moldova or Romania, or that would essentially, even if it froze everything, keep it frozen, because it appears that many of the potential outcomes could just embolden Russia to take more actions in some of their Baltic territories, and that just keeps this lingering and lingering and lingering. So some kind of definitive end to all this. There's a lot of ways in which that could shape up, but I think it'll be an unfolding process, not something that's going to happen day one, of course, as it was sort of talked about, but something that's going to unfold over quite a period of time that needs to get Europe on board, needs to get Ukraine on board, a lot of different parties involved. It'll take some time, but I think the key is to contain any further Russian progression into some of those other territories.
Great. Thank you. I'm going to pivot to a couple of kind of more educational questions in a second. But before I do, is there anything on your mind that you wanted to touch on more about current events or the current setup before I jump over to those?
No, I think we've hit a lot of this stuff. I think this pattern on announcing a tariff and then not implementing it, I think is just echoed again and again with Colombia, Mexico, Canada. That was true back in 2018 and 2019 too. So we've got this pattern established. I think the market is confident now that that pattern extends. The risk is maybe that it doesn't. So that's why we're going to stay on our toes here. I've been talking about how the tariffs are probably more bark than bite. And so far that's been the case. Even where they were implemented in China, they were implemented at 10% and not 60. But we're not done with this yet. So I expect a bit more volatility this year, but I'm still clinging to my positive outlook for markets, in particular international outperformance this year.
Just related to that, how long into a one-term presidency, because this is his second term, will markets care about the tariff bark and bite? Like, I mean, obviously in his fourth year or late into his third year of his term, it's probably going to be a non-event compared to right now, early in the term. Is there a point in time at which the markets could or should start shrugging off some of this?
What do you think?
I guess since I asked it the way I asked it, I would imagine at some point, yes, it becomes more of a lame duck conversation, right?
I wonder when that happens. And so, I think to some extent you can, make a lot of noise around this stuff once, and you get, okay, we'll give you some of what you want. Twice, all right, we'll give you a little bit more. 3 times, 4 times. I'm not sure how many times you can go back to the same, sort of pointing the gun at your head and saying, no, I'm serious, I'm going to do this, and then not do it and get more and more concessions. So I think there's a diminishing returns to tariff threats that probably comes in the faster you make them. So given how fast they're coming, that point might just be, months away and not years away. We'll see.
The tariffs that were actually implemented in Trump's first term, did those get carried through by the Biden administration, or did they reverse course on them by and large?
Nearly every one of them was extended or added to. There were a couple that were reversed. So the steel and aluminum tariffs were reversed a little bit. But for the most part, they were kept in place, but they were easy to get around, right? So if when you put a tariff up, a wall around one country, it's fairly easy to get around it. So, for example, the tariffs on China, well, China just simply exported products through Cambodia, Vietnam, or Thailand, and then on to the U.S. to avoid the tariffs. We're importing a little bit less from China in a few categories. We're importing exactly that same amount from Vietnam, Cambodia, and Thailand, but we're noting that those three countries are getting those same products from China. So they're merely just passing through. We can see it in the codes, in the World Trade Organization codes as the stuff passes through. So they're fairly easy to get around. So there wasn't really a point to changing them or anything. They were just sort of moot at that point. But they were sustained. So these are built on top of those. But when you build up more walls, if you're talking about targeting a whole category of products like cars or like semiconductors, wherever they're from, that's going to be a harder one to get around and could have some inflationary consequences.
Great. Thank you. I appreciate that. The two educational questions I wanted to ask you, one relates to following the global market. So a lot of US based investors sometimes struggle to reconcile what's going on in their portfolios if they're invested globally with what they're seeing on TV with the S&P and or the Dow Jones or other US based indices. How would you follow your portfolio if you were a global stock market investor compared to a more US centric one?
That's a great question. So I spent a lot of time watching like the MSCI World Index, which is a developed market index that includes the U.S. The U.S. is about 66% of that index. So it's a global index, certainly weighted to the U.S., but it gives a better sense of what's going on globally. I also tend to look and think about sectors globally. So there's some sectors where the stocks are more concentrated in the U.S., like tech, some like energy or financials, where most of them are actually outside the U.S. So sometimes thinking along sector lines can really help. Again, I mentioned that the U.S. is like a tech ETF. Well, you think about Australia, it's a metals and mining ETF because that's generally iron ore and copper is what they produce there. Canada, very much a financials ETF. Biggest sector is banks up there. If you think about the UK, it's an energy ETF. All that North Sea oil, it tends to move in lockstep with the energy sector. So sometimes I tend to think that way because the news tends to be driven a lot by politics, and politics are often a pretty bad decision-making criteria when it comes to investing overseas because like Germany, tremendous political upheaval. They're having another election on Sunday, yet German stocks are up 13% this year because of this recovery in manufacturing. Germany is basically an auto ETF. So as things begin to improve there, they're seeing some better performance there. So rather than pick one particular country to focus on, I think then you've got the sector risk, right? So now with international coming back in favor, I think you can be more broadly diversified and think about having a group of sectors in your portfolio, not concentrating in just tech and just the US, but thinking about a broader, more diversified sector portfolio, which would naturally include exposure to a lot of these countries that are really the drivers of that sector exposure from a global perspective.
Great. No, I appreciate that answer. So I've been, at Heritage since 2013. So talking to you and following you since that time. And at that time, I think the global stock market was just under 50% US. And now I think you mentioned it's a little bit north of 65. Is it enough to have a 65-35 split to take advantage of international markets, or should you right size that just given how much the US has outperformed? And if you go back to kind of the original setup of this, should you be more of a 50-50 if you think there's going to be some sort of international outperformance and you're going to just capture less of that because the global market has become so US centric?
So, given my perspective that we are in a cycle now that's more rewarding for international, not just this year, but for years ahead, I think it does make sense to rebalance back towards more international exposure. The right weighting of international versus U.S., that's going to be probably a little different for everyone. But I think that my answer is probably the same across the board to anyone who asks me. It's, how much should I have in international? Probably more than you have today because of since 2013 what's happened. Internationals underperformed, valuations expanded so much on the US side that we've really seen them really take up much more of that global market share. I think that probably reverses over the coming years, so allocating more towards international I think will benefit a portfolio in the years ahead.
Great, Jeff. I really appreciate your insights as always, and thank you for sharing them with us and our listeners.
Thanks for having me on. Look forward to next time.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakamis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.